Hey, good afternoon, everyone. Hope your day's going well. Hope everyone's enjoying our summer season as we move through it. So, this month in the education moment, I wanted to talk about what I consider probably the biggest looming financial crisis that is on the horizon for most senior households, and that's the impact or over reliance upon Social Security that most of these households have. Statistically speaking, for homeowners age 65 and older, they generally utilize roughly 50% of their monthly income comes from Social Security. There are some senior borrowers age 65 and older where that percentage is actually a lot higher. Roughly 25% of those senior households rely upon Social Security up to about 90% of their household income. So when you have about 75% of senior homeowners age 65 and older relying upon this amount of Social Security income on a monthly basis, the biggest concern coming down the road is what happens once one of them dies, assuming these are two-person households, which some of them are, some of them are not. So this month, I actually wanted to go over a case study for a couple that I actually closed a reverse mortgage on 2 years ago. So this particular couple, they were both 67 years old. They were just a few months apart in birth dates between the two of them. Their combined household income was roughly $4,000 a month, of which approximately $3,500 a month was Social Security income. So roughly, almost 90% of their income was Social Security. I think it's 87%. This couple, like a lot of couples, roughly 45% of homeowners age 65 and older are still making mortgage payments. This particular couple was making a mortgage payment. Their current mortgage at that time had a balance of about roughly $154,000, and their monthly payment, just principal and interest alone, was a little over $800 a month. For them, their concern was what happens once one of us passes away. The breakdown on their Social Security income of the $3,500 a month in combined Social Security income they received, it was almost split and even. It's one of the few times that I've seen a couple that has almost similar Social Security incomes for a two-person household. So they knew that once one of them passes away, they were going to lose almost 50% of their income once that spouse died. And so they were obviously concerned about it. And the good news is they reached out to me at a time that would allow us to do some things now in preparation for that event that is going to happen somewhere down the road. Keep in mind, I'm not sure what the statistics are as far as how much, on average, two-person households, what time or when are they passing away. But we know most of these couples will experience one of them passing away sometime in their 80s, more than likely. Obviously, if their health is good, it may be a little bit later in life, but on average, I think, early to mid 80s, one of them will more than likely be passing away. And so the concern was, hey, what's going to happen when that comes? And so one of the things I like to educate on is the concern on seniors making mortgage payments when there's a better way to utilize that cash. And so for them, we did utilize a reverse mortgage. Here's kind of the breakdown on some of the aspects of it. Home value at the time was $520,000. They owed just under $155,000, so we were able to pay that off. After paying off the existing mortgage and after paying for closing costs, they were left with a additional line of credit or additional funds they could tap into at some point of just over $110,000. I think it was roughly $111,000 and change. My counsel to them was, right now they were making a $800 a month payment. I suggested, why not make a $500 a month payment into the reverse mortgage? And the reason is, for every dollar paid into the reverse mortgage as a payment, that dollar automatically moves over to the line of credit. Obviously, it gets attributed to interest or mortgage insurance premium or principal, depending on how much that payment is each month. So making payments into a reverse mortgage not only helps to keep the loan balance, it slows down the growth on the loan balance, but it also finds its way over dollar for dollar into the line of credit. And for them, by making $500 a month payments, assuming they do this for the next 15 to 16 years, at that point, they'll be in their early 80s. That line of credit growth factor would be just over, a little over 300,000 based on our estimations at that time. One of the nice features about the reverse mortgage, in particular the line of credit, is HUD does allow that line of credit to grow. So it basically grows at the interest rate plus the annual mortgage insurance premium, which is 0.5%. So divided by 12. So for whatever your monthly interest growth factor on it. But that line of credit is growing over time. So not only is the payment that's going into it helps that line of credit to grow, but there's a growth factor attributed to that line of credit. By doing this, obviously, once one of them passes away, and if they continue to make payments beyond that, they can. But assuming that they don't tap into that line of credit for anything, now we have a line of credit of in excess of $300,000 that the surviving spouse would be able to pull from, and more than likely that would be enough proceeds, assuming their health is in decent shape, to get them through to the end of life. One of the other nice features for this couple is they also had a additional retirement account, roughly about $110,000 into IRA. And so the goal was to leave that money untapped, help it, allow it to grow. They had it in a S&P 500 index fund with Fidelity, I believe. And so they should be getting some decent growth on that over time, other than taking minimum distributions. If they can keep their hands off of that, that would be an additional asset that this couple could draw from down the road. Obviously, we know that there could be other issues that pop up, whether it's health needs and so forth, that may impact this. But the bottom line is they need to take a look at a utilization of something like this in order to make sure they're prepared for that next life event. So if you know of any couples out there that are still making mortgage payments and obviously relying on Social Security for a large portion of their household income, which is pretty typical for most senior homeowners, hey, reach out to them. Let's begin to have a conversation about this. Obviously, if there's a better place for this couple to park that $500 a month and get better growth and secure growth, that's the key. HUD guarantees whatever in that line of credit will be available to them, regardless of the loan balance, regardless of where interest rates go, regardless of what the value of the house is in the future. So the goal here is to make sure we park this money, utilize the limited amount of cash that they have right down, utilize it properly in order to prepare them for the next life event. So let me know if you have any questions. I hope this has been helpful. Reach back out to me if you have any questions or you have any clients that you think might be a good fit for this. Appreciate it. Hope you guys have a blessed day. God bless.